timing and everything. Okay, so most people, okay, so half and half. Okay, good. Good. Okay, so got it. So basically, I'm going to go back to, so again, it's about 6 questions per chapter, and it's pretty evenly distributed going back to the beginning. So,
There's only chapter 1 through 5?
no, it's 1 through 6 and a few questions on 7. It's a few questions on 7, just a couple, because we did very little. It's 35 questions, guys. All right, so accounting, present and past. So the first piece that we're going to talk about is chapter 1, and going back to the different pieces of what is accounting, who are the users of accounting, what are the organizations that are involved in legislating the different parts of the laws that are coming up, the new pronouncements that are coming up. I want you guys to be familiar with AICPA, FASB, CPA, PCAOB, some of the things that they're going over that are major in accounting. And the FASB, just to go over the major one, the FASB is basically the organization that creates new accounting pronouncements. FASB. So it's FASB, it's called FASB. FASB is basically a big deal so if you work in your company and you're an executive, they might issue a new pronouncement that's going to change your whole entire team of people that you need. Like Sarbanes-Oxley, or a new pronouncement for, your industry. And that may change what kind of financial reporting you need to do, what kind of information you need for your financial statements, things like that. And then in terms of the users of financial statements, we have basically 5 different groups of that are interested in financial statements. Management, that creates financial statements. We have investors and shareholders that basically review the financial statements for performance. Creditors and suppliers that essentially want to know if you have the capacity to pay what you have agreed to pay them. We have employees that just want to know the foundation, the stability, if the company is stable. And then you have the SEC, which basically reviews the financial statements to make sure they are in accordance with GAAP, right? So that's another big one. Basically, we have GAAP. That is basically what we've been studying in this class, is the generally accepted accounting principle in the U.S. Generally accepted accounting principles in the U.S. Now, all those little distinctions that we always talk about, when do you accrue it, you don't accrue it, you debit this, you credit this, are little aggregations of almost like ideas. But they've become laws, because according to the SEC, that's a law for them. If you didn't do it, they're like, oh, well, then that's not U.S. GAAP. So that's why the SEC is very important, because that is essentially accounting laws. 3 types of accounting we have: public accounting, private accounting, governmental accounting. So things are always going to fall in one of those 3. Public accounting, basically they do all the auditing. Private accounting, internal accounting, is basically at your firm. Somebody must be doing all the bookkeeping, record keeping. And governmental is totally different, which is based on a budget. They don't make any money. So they actually spend money based on what is called fund. It's actually called fund accounting, because they have funds, and funds get budgets. And from those budgets, they basically do spend. And they don't receive funds as businesses do. They appropriate funds from the budget. So it's nothing to do, like it wouldn't be the same as what we've been talking about, because it's all based on basically transfers between one department and another department. And then they do their spending. All they're supposed to do is spend the money that they receive. So that's essentially, some of the pieces that we go over. Another big piece that we've been going over is the IFRS. IFRS is the international version of GAAP. It's like international GAAP, IFRS. And this is something that's important because Europe, Asia, these companies have been converging this whole international standard. And GAAP has been trying to basically converge with it. And they've had some issues, but it's still being talked about a lot is, hey, could the whole world be on one accounting system? Imagine the possibilities. Everybody depreciating the same. I'm just kidding. But no, but there are benefits to having one standard, which is the SEC has been working on for 10 years. And that basically what they're trying to do is some companies, very unfortunately, have to do both. If they're listed in London and New York, they have to do both because they're filing with that jurisdiction. London is doing IFRS, US is doing GAAP, so you're gonna have to basically get have two teams of accountants. Nobody likes that. PCAOB. What is the PCAOB, right? PCAOB is the Public Company Accounting Oversight Board. This was created after this whole process with Enron and Arthur Anderson, was it called, I think. Basically, with all this fraud that happened back in 2003, they actually started auditing the auditing firms, PCAOB. So it's like basically an oversight body of public accountants. So they come in and they do the audit of the public accounting firm. And they, provide their insight of whether it was done in accordance with, the best practices, essentially. And then we had the whole piece about ethics in the accounting profession. This is also something that is a big piece, and I think we've been going over it here and there in terms of, we talked about fraud and things like that, but more if you're in the accounting function, or say, a lot of times people become executives from either marketing, science, or accounting. But as soon as you get that at executive level, when you do make accounting decisions, or you do make business decisions that affect the financial statements, you may be in a position where you make a decision that affects the financial statements, that is material. So what we're talking about here are the three aspects of integrity, objectivity, and independence. So independence means that you don't have a vested interest. Say you're about to approve this new product. If you have options on that product or something, or if you have some kind of agreement that you get money from that product, that takes away your independence from essentially booking that. Any kind of vested interest, any kind of, benefit that you might get, that ruins independence. So integrity and objectivity. Integrity means you do it in accordance with GAAP. So say without any kind of even thinking about it, you just open the book, and you look through it, and you look exactly the regulation based on it, and that's how you do it. Right? Of course, there's a lot of gray lines, but integrity says, hey, this is the precedent. This is how people who have done this transaction right have done it before. And you can do it in accordance with the law. And that's basically integrity. Objectivity relates to independence. It's basically you're a non-partial observant. You're in a way doing this as somebody who doesn't have a vested interest. So a lot of times I remember in auditing, we saw transactions that are not objective. But since auditors, we don't have any vested interest in their business, we'd see it and then you run it by like 5 other people and they all say the same thing. This is done a little bit different than usual. So that's objectivity. Many people look at the same thing and they'll see the right thing, as opposed to somebody who has a vested interest might see it from a different angle. And they may even believe that that's the right way, but their view might be skewed. So that's why, in accounting or transactions, a lot of times you want several people signing off on it. It's just a control. And then basically we talk a little bit about some of those core attributes of accounting. I think we get into it more in chapter 2, but in terms of some of the core attributes of GAAP, we have here, it's basically there's an entity. Always there's an entity that we work with. Right? It could have a subsidiary, it could have a sister company, it could have a parent company, but it is going to be some kind of entity. There's also a period. In other words, there is a certain period of time that this will cover. It's not going to be indefinite. It's not going to be 17 years. Not with gap. It's going to be, it'll tell you exactly this is for the year or it's an as of a specific date. There's a unit of account. In other words, we're talking about in US dollars. You won't see financial statements in two currencies. Sometimes you translate from one currency to another, but you will not see financial statements in multiple currencies because it will violate this unit of account concept. Accrual, which we always talk about, which basically means you book things when you find out about them, not when you pay them. It's done as of basically what you already know is going to happen, you book it, and that's called accrual. Completeness. That means that anything that has happened to your business will be reported in the financial statements. So sometimes people don't even know of the things that are happening in the business. That means the financial statements are wrong. So in other words, you are liable with knowing everything about your business because once it's issued, it's complete. You know, so that's basically part of it. And conservative. Conservative means that we're not going to up asset values and estimate higher profits in an aggressive way. Not that it's not right if asset values have risen much or profits seem to be going up much. We're going to go for the conservative view and say what is the most probable scenario. What is slightly less than the aggressive view, because it may come down and then it will be a loss later. So they go conservative in order to reduce the amount of volatility and the amount of errors, because it's basically a long-term view on the company. It's not doesn't take the short-term view of things that needs to go up and down every quarter. So these are the main things, and I think we go over it here and there. And materiality. Materiality means that basically the accuracy you receive from spending more money on accounting for something should be worth more than the money you invest into this. So in other words, say you're missing $300 in your books in your department somewhere, and the accountant can't find it. They say, we could find it if we travel to every branch and I reconcile every specific plant's books. But it's in 30 states. So I need a budget for this of like $20,000, and I'll send the assistant to do it. But it's like, we're going to spend $20,000 to track down $300? No. Basically, materiality means, and this happens a lot with accounting. I've encountered it a lot where they would be like, this is costing way too much. We're not spending money on this. Because you're not supposed to be spending so much money on that much more accuracy. In fact, you should get more value out of the accuracy you invest with your effort than the amount. So that's basically materiality. Saying that take on procedures that create accuracy that are effective and efficient, rather than costly procedures that get very little accuracy. It's more like a auditing thing, but it does happen a lot in internal accounting also. Any questions, guys, on this one? That's basically all chapter 1. I want to go over a little bit more detail with these because we haven't done this in a while as opposed to the other ones. But basically, chapter 2, going into chapter 2, essentially what we have here is the accounting, what are transactions, what are financial statements, and what is the accounting equation. So essentially with this chapter, what we're looking more is the assets minus liabilities equals equity. So that's what we have here. And then equity including kind of like revenues minus expenses. You know, and I think assets equals liabilities plus equity is how the book does it. And equity includes revenue minus expenses. This is where I want you guys to focus on in a way of this equation, figuring out equity, which we have done, and also figuring out retained earnings, which we have done, and and understanding that what is equity really? It's your last year assets minus liabilities plus this year's income. Income goes into equity. That's the part that I know we've been working with. Revenues minus expenses goes into your equity. That's sort of the focus. I mean, I think a couple of questions in this chapter of what's going on, and that's the accounting equation. And then I think what happens next is we go over all these accounts with the balance sheet and things like that. And then we basically go over those accounts much deeper in the coming chapters. So I'll go over that a little bit more. But this is the main new thing that's just in this chapter. And also on page 44, guys, to get into the accounting concepts and principles. I know we go over that. The reason I want to focus on this a little bit more in these chapters because this is kind of what the whole profession stands on. And it's a relatively new profession. It's only been going on for like 80 years or so, but it's been a big profession. So these are the ones that kind of go over, I think, what it's basically accounting concepts and principles. And that part, I want you guys to take a look at as well and understand, because that way you're not memorizing a lot of things in the future. You're kind of relying on a foundation. Helps you a little bit with... and then, essentially, what is going on in terms of the limitations of the financial statements? Limitations is another big part. And I know we go over it a lot in various flavors, but basically the main limitation is that a lot of the stuff is estimates. We're estimating depreciation. Really, it's not a real expense we're estimating. We're estimating when we do warranty expense. We're estimating the amount of warranty. The legal settlement accrual. We're estimating. We don't know what it will be for sure. So basically, the weakness in this whole process is the fact that the estimates could be quite off. And that could be a significant thing.
Say that again?
The estimates could be wrong. The limitations are that basically estimates could have something that is a mistake. And that is the limitation. One might say the financial statements are 100% right. But even the financial statements, it says that they use estimates and they could be substantially off of what they appear right now. But it's to the best of our knowledge that this is like this at the moment. A lot of legal language. That's basically what we have for limitations. And moving to chapter 3, in terms of ratios, basically we have return on investment, return on equity, and DuPont model, which is basically on page 75. So basically, I think we did a lot of work with this, a little bit more recent on return on equity, return on investment, and how does margin and turnover play into this? Margin times turnover is return on investment. I think we did a big workshop on that. So that should be okay, I think, for you guys. But honestly, the focus is on these three ratios and also the liquidity ratios. focusing working capital current ratio and asset test ratio. What are these ratios all about? What is working capital current ratio? Basically, it's all trying to illustrate liquidity. Is there enough cash flow right now? That's not too complicated with those three. They're just looking at your current assets versus your current liabilities. Basically assessing, hey, can you pay the current liabilities using your current asset? And now I think it will be a lot clearer knowing what is current asset we did last week, what is current liability we did this week. It's stuff that is due to you within 12 months and stuff that you need to pay within 12 months. So it makes sense. It's kind of showing what are you going to be facing in the next 12 months. So this ratio is kind of looking ahead and seeing how well off are you going to be in the next couple months, you know? So that's basically ratios. And the whole idea with ratios is that we are looking to identify a trend, right? That is the main idea with ratios. We're not looking right now. This is the thing. Look at Campbell Soup. We're looking at over 5-10 years to look at their return on investment. That's when you're starting to see a full picture of what's going on or where they're heading, because you're looking at a macro view of it.